for Jake to actually start up the presentation. Please feel free to give Michael Hall a call here in our office, and Michael will get you on the list for coming by and having lunch with us here in the office and learning a little bit more about business planning. So we'd love to have you attend that meeting here in our office on April the 16th. On Friday, April the 24th, we are going to have our annual golf outing. That will be an all-day event. Friday, April the 24th. You want to register with us, and please give us a call. Give Michael Hall or Sue McGivney a call here in our office. Make sure you get your name and reserve your spot on the list for that day. That golf tournament will be held at Bears Best in Beaufort, Georgia. Actually, I think it's Swanee, but it's in that vicinity there. But that's a great place to golf. Bears Best is a golf course that has 18 of the best golf holes that Jack Nicklaus has designed in the world. So it's a very nice golf course, and it's a great day. So please sign up for that. And I think we'll go ahead and get started now, since it's about 3 minutes after 10. We do appreciate you guys being on the call again, and hopefully today through our message you'll be able to learn at least one thing that will help your clients, and that's our goal, is to help you understand more about planning with your clients, and hopefully a couple of products that will fit the mold or fit the need there with your clients. So I'm going to turn this over to Jake, and he's going to tell us all about infinite banking.
Thanks, Greg. I would like to thank each of you for taking this time out of your busy day to be on the webinar. My goal today is not to convince you that the infinite banking concept fits every scenario. My goal, rather, is to explain the concept so that you know where it potentially fits and so that you can explain it to your clients. I hope this will be something that will be useful to you in your practice and will help you potentially generate more revenue. So let's get into it. There's a lot of names for this. You've probably heard most of them. Infinite banking is one of them, the one I chose today. You've probably also heard becoming your own banker, bank on yourself, the president's account. I've heard it called this before, and my personal favorite, the 770 account, because everything in insurance is immediately better when it has a number in front of it, etc. So these are some of the names that might be thrown at you, and they all basically mean the exact same thing as what we're talking about today. I wanted to start off with a couple of quotes here. First one from Thomas Jefferson: "The modern theory of the perpetuation of debt has drenched the earth with blood and crushed its inhabitants under burdens ever accumulating." That's pretty scary. My personal favorite here for this concept: "The rich rule over the poor, and the borrower is slave to the lender." Why do I bring up these quotes? Because the infinite banking concept is not just a product. It's really about a particular mindset that some people have when it comes to finance. The kind of person that is going to be interested in this product is someone that really believes that it's worse to be in debt to someone else than it is to be in debt to yourself. It's going to be somebody that's dedicated to financial security and flexibility. Now you might say, well, isn't everybody dedicated to that? I would say no. To be dedicated, you really have to actually follow through. And that means that you have to be able to put money away for this. You have to be able to fund this concept. You're going to be somebody that wants to control your own finances. You might be somebody that potentially thinks they're going to have difficulty getting a traditional loan. Now, I do, on the side, I buy and sell houses that are in bad condition. You might call it house flipping. It's definitely house renovation. But I can tell you that that's a particular scenario where it would be very difficult for me to get a traditional loan to fund what I'm trying to do. So this would be something that could potentially work in my scenario. Also, you might be somebody that likes the idea of a forced savings vehicle. Having this concept set up for you is an automatic way to put away money. So you're not having to constantly remember that you're investing in this or that, but you have a bill coming from the insurance company. It's definitely more of a forced savings vehicle, which is definitely good for some people. So what is the concept of infinite banking? The main concept is that you're creating a pool of money, we'll call it your own bank, which you can draw from to pay for things that you might otherwise consider financing through another institution. You're going to take loans from your own bank when needed instead of taking that loan from somebody else. And instead of paying somebody else back, you're going to pay yourself back the principal and interest that you would otherwise pay to someone else. This part of it is very important, and I'll go into that later. Over time, you're going to build wealth, and you're going to protect your family with a death benefit. That is really, in a nutshell, the concept of infinite banking. Now, there's a key point to this to understand it. And some people have not wrapped their head around this point. Everything that you buy is financed. Well, you might say, well, what about all the things that I just, buy from my own personal savings? I'm not really financing that, am I? Well, if you think about money the way that a banker thinks about it, or the way anybody in finance thinks about it, then yes, you are actually financing something that you pay out of your own funds. Because you can call it the time value of money, call it the cost of capital, you could call it opportunity cost. If you are taking money out of your own pocket to pay for something, you are giving up the interest that you otherwise could have earned on that. So whether you're taking a loan from a bank, whether you are taking a loan out of your own pocket, or whether you're taking a loan out of an insurance contract, there is a cost to that, and in a sense, you are financing it. The real question is, since you're financing everything, what is the most efficient way to finance your lifestyle? You could ask yourself, would you rather pay somebody else to use their money, or would you rather pay yourself to use your money? Can you do that? And that's what we're going to look at. So now that we understand that everything that we purchase is financed in some way, what are really the methods? Here's what most people are going to think of: traditional lending. Whether you're buying a house or a car or whatever it is, you're going to the bank, and they're going to look at possibly collateral, they're going to look at your credit score, and they're going to qualify you for a loan. For this particular scenario, I'm going to assume that qualifying for a loan is not your issue. You can qualify, no problem. Of course, they're going to charge you interest. There may be some sort of fees. There could be a closing cost depending on the type of loan. This is the most traditional option. Also popular, you could use your own capital. You could take money out of a savings account. The issue with this is you have to build up that savings account. It needs to be a liquid savings account. It can't be in something that's difficult to get your money out of. It probably should be low risk, because you don't want to have, you don't want to need to take money out when you have had a bad year. Your earnings on this, we're talking about non-qualified money here. It'll be taxable. And when you take money out of it, as we discussed, there's an opportunity cost. You're giving up that the earnings that you could have made. Third option that we're talking about today: create your own, quote, banking system from which to borrow. One of the big objections to this, not an objection so much as a necessity, is that it's going to require a funding period. You have to be able to put money aside and discipline yourself for a period of time, usually somewhere from 7 to 10 years, to get your system up and running. In the infinite banking world, they would call this the period where you are basically establishing your own bank. What are some immediate objections that you would be likely to encounter when you bring up this concept to somebody? They might say, I don't have the cash flow to fund this. Now that could be a real reasonable objection. That could be the truth, that they don't have the cash flow to fund this, in which case I would say that this is not an appropriate option for them. However, what they might actually be saying is, I think I can get a higher rate of return somewhere else. You're probably going to hit this one a lot. Whether or not they know it, what they're really saying to you, because of the way money works, what they're really saying to you is, I think I can consistently get a higher rate of return than a bank will charge me, okay? Because there's things in their life they're going to be financing, as we discussed. Everything is financed. And what they're saying is, you know what, I think that I can consistently get a higher rate of return than what that money costs me, than what I'm giving up. So let's look at, I wanted to look at this somewhat in depth to compare it to other options that your client would have, other places they could put their money. Is it actually better to be somewhere else, or does this infinite banking concept actually have some merit to it? All right, I'm going to look at two different clients. The first one, the male, age 35, good health. So a young guy, and he is in good health, can get a really good rating class on the insurance. Okay, we're going to look at funding car loans. So one of the main things that this guy borrows money for is to purchase cars for himself and for his wife. He typically buys 2 cars every 5 years for a total of $60,000, but he pays off the loan in full over 5 years. So this guy's pretty responsible. He's not leasing these cars. He is actually purchasing them, and he is paying them off over 5 years. So when he's done every 5 years, he trades them in for about $10,000 a piece. So he's really only borrowing $40,000. Okay, so this is the scenario we're looking at. Every $40,000, he gets 2 new cars and finances them over 5 years from a bank. Option 1, he can get the loan from a bank and set up a side fund. This is probably an immediate, this is what I personally would be my first objection. I'd say, you know what, I can invest the money somewhere else, I can get a loan from the bank, and I think that might be a better option for me. I think I could do better that way. So this person's going to invest $500 a month for 10 years. Okay, this is the funding period we're looking at for the infinite banking, a 10-year time period. He's going to invest $500 a month for 10 years into long-term, high-grade corporate bonds, yielding 5%. I've pushed everything out a little bit into the future as far as rates of return. So you'll notice the returns I'm showing are a little bit, in some cases, a good bit higher than what you would get right now. He's, at the same time as investing this, he's going to borrow $40,000 from a bank every 5 years and pay it off over that period with a 5% loan rate. It's a little bit high right now, but like I said, historically that's a reasonable rate for sure. So he's going to do this every 5 years from 46 to 70. How much money does he have in that side fund at the age 70? He has $185,444. So by investing a total of $60,000, $500 a month for 10 years, and letting it grow, and then borrowing from a bank on the side to finance his lifestyle, he has earned $185,000 by age 70. Okay? That's scenario 1. Scenario 2 is a personal loan option where basically, you are investing $500 a month for 10 years into a money market account. Very low rate of return, but this money is extremely liquid. So you're basically putting this in the bank. You're going to borrow $40,000 from your own account. You're not going to go out to a lender. You say, hey, I've got the money. I'm going to borrow it for myself. And then you're going to pay it back to yourself over the same period of time. This is less favorable because you're earning a lower rate of return in this scenario. Your cash is $115,000 at age 70. Option 3, infinite banking concept. How does this look? How does this compare to those 2 other scenarios? We're going to invest $500 a month into a 10-pay whole life contract. The nice thing about a 10-pay whole life is it's already set up to be maximum funded. You pretty much can't put any more money into this, into a paid-up additions rider, without creating a MEC. So it's pretty much automatically overfunded to the max. You're going to borrow $40,000 every 5 years from your own contract, and you're going to pay it back, assuming the same interest rate you would have paid to the bank. So this is a key point. You're borrowing money from your own contract, but you're also paying yourself back as if you were paying a bank back. Your cash at age 70 is $285,000. You notice that's a lot higher than either of the other scenarios. So right now we're looking pretty good. Your death benefit also, let's not forget, this whole time you've had death benefit protection. age 70 is $463,000. Your net amount at risk during this whole time for the insurance company was about $200,000. So your pure insurance was about $200,000 for this entire time. So that has a large benefit to it. For male age 35, the benefit of that coverage over time was about $1,000 a year. So you had a good bit more cash growth. You had flexibility, didn't have to get permission from a bank to borrow money, and you had this $1,000 value per year of life insurance coverage. Pretty good deal. I wanted to show you an illustration because everything I've been talking about, I know the numbers are pretty confusing until you look at it. Here is an actual whole life illustration showing him paying the $500 a month, $6,000 a year for 10 years, and then he starts taking his loans to buy his cars. So he takes a $40,000 loan, and then he pays it back. This is a 5% interest rate he's paying himself back at. He's assuming that's what the bank would charge him. Pays himself back over a 5-year period, and then he does it all over again. And he continues to do this, and as you can see, his cash value continues to grow and grow and grow. Okay? So the key concept here to remember is instead of paying somebody else to use their money, he's basically paying himself back to use his money, all the while having a death benefit. For a graphical look at it, you can see that in the beginning years, up through 10 years or so, the infinite banking concept lags behind either personal savings or having a side fund and getting bank loans. It lags behind in cash. That would be the so-called startup costs for the bank. Once you get farther into it, this middle column, you see that the infinite banking concept has started to pull away a little bit. And when you look in the long term, in this case 35 years, you can see that it had, this is age 70, that it is, it's taken off, and it is far exceeding the other two options at that point. So overall, it's looking pretty strong for this male age 35. What's the break even? So if you were to look at age 70, this would be a question I would ask. Age 70, what return would a taxable investment have to make to break even with the infinite banking plan? So meaning we have the same amount of cash at age 70. What return would I have to earn? In this scenario, you'd have to earn about 7%. And that's not considering the value of the life insurance you've had. Okay? If you consider that $1,000 a year that life insurance is worth, your break even is about 8.5%. So this is looking really strong for this particular client. The immediate question that's going to come up from you after this is, okay, that was a male age 35. What about somebody older? Does this work for somebody that's a little bit older than that? And I would say, yes, it does. Let's look at a female age 50, also in good health. When I say good health, it could be, you could be in standard health. You probably don't want somebody that is seriously rated, but you are overfunding a contract, so the cost of insurance is not as huge of a factor as it is when you're just trying to get the lowest premium. But somebody in good health is going to get the best scenario for sure. This woman wants to have money put aside for her daughter's wedding in the future, would also like to pay for some grandkids' college tuition. I would say it's a pretty reasonable scenario. For our purposes, for this illustration, we're going to assume she pays $25,000 for a wedding 10 years from now, and she's going to pay $40,000 a year in tuition for 4 years for 2 of her grandkids, so $20,000 a year in tuition. How is she going to finance this? Let's look at the 3 different scenarios we looked at for the other guy and see what it looks like for her. First option, the bank loan with a side fund. She's going to invest $800 a month for 10 years. Same scenario, she's earning 5% on these long-term corporate bonds. She's going to borrow the wedding and tuition money from a bank and pay each one back over a period of 4 years. That's her plan. It doesn't have to be, you don't have to plan all this exactly up front by any means. In fact, you probably don't want to. This is just, you could do it this way, you could do it another way. This is just particularly what I chose. Her cash at age 80 in this scenario is $246,000. How does that compare to the personal loan scenario? Well, as we know, we're earning a lower interest rate in this because the money is so liquid. We're going to do the same thing with it, and as you'd expect, you have a lower cash value. So how does the infinite banking concept stack up for a 50-year-old female? Investing the same $800 a month, borrowing money out of her own contract and paying herself back over time. Her cash at age 80 is $313,000. So she has, even at 50 years old starting this plan, she has had time to build it up, time to use money, and she has done better than she would have done in those other two scenarios. She has a death benefit at age 80 of $450,000. Average value of that life insurance coverage to her was about $1,700 a year. Pretty strong. Same thing. You can see that, and you can just tell your clients this up front. This is a long-term strategy, as everything with life insurance is. It doesn't beat these other scenarios initially. Over time, it does exceed them. So you're going to have to kind of commit to this over a longer-term period of time for you to see the results, to reap the benefits of setting up this plan. What's the break-even analysis again? We're looking at a break-even at age 80 here. Your taxable investment would have to earn over 6%. So we're not talking small money here. It's earning a good percentage rate to break even with this plan. If you take into account the insurance, same thing, around 8.5% when you take into account the value of the insurance. Okay, what are some main considerations? Now that we've seen what it's about, what an illustration looks like, what a couple of scenarios would look like against other investments, what are some main takeaways that we need? Okay, what are we going to do this with? Typically, traditionally, this has been done with a max-funded whole life contract. What do we mean by max-funded? Is we are putting as much money into paid-up additions riders as we can without creating a modified endowment contract. Like I said, a 10-pay whole life kind of automatically does this for you, and so I particularly like that contract, although we could use all kinds of different whole life. Non-direct recognition loans are important. Not to say you couldn't do it without this, but this is pretty important. I would want, for sure, a contract that has this. What does this mean? Non-direct recognition loans mean that the company is going to continue to credit the money that you have loaned out of the contract at their dividend rate. And so essentially, you can end up in a situation where you are either getting a zero-cost loan. You could even earn a little bit of arbitrage. It could cost you a little bit because the variable rate loan is variable rate. So basically, you're pitting the dividend returns against the variable rate loan of the company. And historically, this has looked very good with big mutual companies. This has worked very much in the favor of clients. So having non-direct recognition loans are important for this concept. Like I said, you need a capitalization period. You need to tell your clients, look, you need to put away money for about 7 to 10 years. If you can do that at the right amount of money, then you can finance your lifestyle out of this contract. You must be willing to repay loans. This is not a scenario where, let's say, a retirement supplement sort of life insurance scenario where you're putting in a bunch of money and then you're taking out loans in retirement and you're never paying them back. That's a great scenario, but that's not what this is. You are paying yourself back, just as if you are your own bank. You're not going to take a loan and not pay it back. You're going to take it and pay it back to yourself. You could take a loan and never pay it back, and it could potentially work, but you're not going to be building wealth over time. So with this particular scenario, you're willing to repay the loans. This scenario provides flexibility where a traditional loan would be hard to get. I brought this up at the beginning. There's some people, construction industry is pretty big for this, where a loan in a particular scenario might be difficult to secure. But if you could just take that loan from yourself, you don't have to ask anybody. You just send the notice into the insurance company, and they send you the money. Okay, I haven't talked about a product, but here it is. MassMutual's 10-pay whole life has all the pieces. It works very well. Okay, it's basically maximum funded. It has non-direct recognition loans. The contract is incredibly competitive, and MassMutual's dividend interest rate history is phenomenal. Okay, so you want a place where your client is going to have a good experience for sure. So you have to pick a good company. I know I'm going to get this question. Could you use Index UL? I've had people tell me you can. I would say that you can, but I do not think that Index UL resembles a bank nearly as well as whole life does. It has less guarantees, and it has more volatility. The whole idea here is that we want the money to be relatively steady and reliable, which is you may get a higher return over time with indexed UL, but that's going to be up and down over time. So I would recommend talking about this as more of a traditional whole life contract. I mentioned Mass Mutual. You want to have something where your client is comfortable. Here's their dividend rate since 1978. I could have gone back farther, but it looks good farther back, and I think this is enough. You can see that we have a very strong dividend interest rate history at Mass Mutual. Right now, we're at a pretty historically low point in our economy, and they're still crediting 7.1%. You can see a few years back they went down below 7, but what I love is you can see that they go down when they have to, but then they bring it back up when they can. And so this is not an introductory rate type of product. Okay, they're committed to this product. They're committed to their clients, and that's one of the things that's nice about a mutual company in this particular scenario. So the interest rates history looks phenomenal. All right, I am pretty much through describing the concept. I hope that kind of answered your main questions about how this works, what kind of product could be used, and how it compares to other investments that are available to your clients. At this time, I would love to take any questions that we have. Dwayne, have we gotten any questions typed in?
I don't see any questions currently at this moment.